touch base with our special guest this morning. Gautam Trivedi, Managing Partner, Nepean Capital, joins in right here in our studios to discuss his market outlook. Gautam, it's great to have you on the show. Thanks very much for stopping by. How are you sizing up the markets currently?
I think people need to get real about the fact that the 5-year bull run is over. I think that's really what I think a lot of people are still not able to grapple with. Especially the newer investors who've come in, especially in the last 3 to 4 years, because a lot of retail investors are first-time investors, and I think either they were missold or they thought this could go on forever. But historically, if you look at bull markets in India, they don't typically last more than 5 years. So if you look at the previous bull run, which began in I think January 2003, ended exactly on the 4th of Jan 2008 because of the global financial crisis. And the current bull run began, I think, September 2008 and ended almost exactly 5 years later. So I think this is the new reality people have to deal with.
But what will peg back the markets, if you could explain that a bit more, given the fact that I can understand that the upside may be capped, but I don't get, because if the bull market is over, then you're talking about a reversion to the mean. And if that's the case, then what could potentially open the downside?
Yeah, so I think there are a bunch of things that have actually helped the bull market in the first place. So we saw interest rates falling, stable government. Government's still stable. I'm not necessarily saying that's changed. But the fact is there are a bunch of things that actually went in the favor. Falling oil prices, of course, and a stable currency. All of that have reversed, with the exception of the government. And as a result, I think people need to digest the fact that this cannot consistently go on. We're heading into a very turbulent time with respect to elections. Earnings as well. I think the impact of higher oil prices and Forex will impact earnings for the current quarter, which will be reflected in results starting in 7 weeks. So I think that is an issue that hasn't been fully digested by the market, and I see, frankly, further weakness in the market.
I read a CS report in the morning which says that rupee at 70 plus is good news for India because 60% of the Nifty numbers are dollar denominated. So the argument here would be, whereas currency is going to have an impact on importers, but your metal companies will gain, they are dollar denominated, IT is going to gain, pharma is going to gain. So how would you counter that point?
See, I think there's a fallacy in the market in India, the fact that rupee depreciation helps exporters. And over the past about 3 weeks, I've spoken to over 20 exporters who are in different businesses. Some are traders, some are in the textile business, some are in the metal exporting business as well. So what they've said is the rupee depreciation doesn't necessarily help them. First and foremost, most of them are hedged. So they aren't able to take advantage of the spot fall in the rupee. If that comes in, that will be only 6 months from now when the positions get, when they start fresh hedges. The second and more important factor is that I think, unlike China, we don't have the basic infrastructure for exports in terms of infrastructure at the plant level, plant to the port, and at the port itself. So there's some progress there, but we're still way off as far as that's concerned. The other problem, the third and I think bigger problem, is that a lot of the customers, the people I spoke to, are actually demanding discounts given the rupee has fallen. So they're not really seeing a big benefit of rupee depreciation. You're right, some sectors like metals may actually see a positive, it could be positive for them, but I think apart from that, it really doesn't really help exporters in the long run. You need other factors that can help exporters, and clearly we lack a lot of those.
So what's the take then when it comes to individual sectors such as the IT space? How are you looking at what investors should do here?
Yeah, actually, I'm glad you brought up the IT space. I forgot to mention that on the currency. If you've looked historically, with every depreciation of the rupee over the past 10 years, the margins have been pretty much constant for a TCS at about 25 to 27%. Infosys is at the same 24, 25%. So at the end of the day, it's not really helping. But having said that, I think given what we see even now for the next 6 months or so, turbulent times for the market, I think IT would be a good place to be in.
What about, sectors that you would steer clear from? Where is it that you believe that investors should not touch this space with a barge pole?
I still am not comfortable with the NBFC space, especially the housing finance companies. I think because the real estate space in India is going through a very turbulent time, and it's a global real estate correction that's happening all the way from Los Angeles to New York to Dubai, of course, that's well known, and Hong Kong, China as well. So I think the real estate space in general is really badly impacted. You'll see more issues with that space over the next 6 months. And a lot of the housing finance companies that I've spoken to are very confident that there's no problem. And they all say that we've only lent to the top 10 developers in the country. Mm-hmm. And if that's, if of course one or two of them have a problem, then I think it'll have a cascading effect. I think the other thing to talk to when I talk to builders, especially the home builders, home developers, is that a project initially was sized for two kinds of buyers, an actual buyer and the investor buyer. The investor buyer has gone to zero, and the actual buyer is down about 60–70%. So as a result, you have a lot of unstocked inventory sitting in India, which is clearly going to impact cash flows for the developers, which in turn impacts their ability to repay the housing finance companies.
So equities in a bear market, property in a downturn.
Well, property's been on a downturn for the last 5 years.
So what should one do?
Yeah, I'd say buy Titan. No, I'm serious. I mean, fabulous numbers.
Buy gold.
Buy gold. I mean, not physical gold, but buy Titan.
If you think it's a bear market, the bull market is over. That means stocks will come down, right? So one should not buy stocks, because if your definition is centered around the fact that bull market is over, that means you should avoid equity as an asset class. I don't want to get this wrong, but that's what you're indicating, right?
I am definitely saying that. Having said that, there'll always be stock-specific opportunities. So let's not ignore that. I'm not necessarily saying the entire market is a sell and everybody should just liquidate their positions and we'll be sub 8,000 or whatever. Nifty.
Okay. And Titan is one such opportunity.
Titan, I think, is a great story, frankly. I think it deserves the multiple it actually trades on. And that's probably been one of the biggest beneficiaries of the GST versus a lot of other sectors that just haven't been able to capitalize on GST as yet.
Okay. Ashok Leyland is also part of your list, is that right?
Yeah, we've actually been covering and tracking Ashok Leyland since it was about 15 rupees, and it remains a secular growth story. But of course, the economy, subject to the economy doing well.
Do you still think?
And we love to be this contra devil's advocate. If you say you don't like Ashok Leyland, I'll ask you why you don't like. Now you like Ashok Leyland, I'll ask you why you like Ashok Leyland. So I will just love to take these differentiated sides, devil's advocate. The CV cycle is in a 5-year bull run.
Yeah.
And if the economy peaks out, the CV cycle will peak out. So the logic for Ashok Leyland, some would argue, is also tying in with your initial thought that if the economy is going to go through a painful period of grind, then Leyland should be the first stock you should be getting out of.
I'm not so much concerned about the economy, it's more the market itself and the valuation, the multiples of the market. So it's less the economy, it's more the equity markets. Of course, a lot of what I'm saying will be also impacted by the strong flows that we're seeing domestically. FIs have been in and out this month. But in general, I think as long as the flows remain strong, people will have to invest. And as a result, the market may not necessarily fall that much, but I'm not so concerned about the economy. I'm more concerned about the overall equity market.
Typically when the markets correct, you will always see two types of corrections. One is price correction, and second is time correction.
Yeah.
Where do you think there is scope for more price correction, and where do you think there is scope for time correction?
If I look at, let's say, the ceramic industry, which a lot of people had bid up as a sector and stocks in general, hoping that the GST would weed out the unorganized sector and the organized players would significantly benefit. But that really hasn't happened. The unorganized sector continues to flourish, unfortunately. And they haven't really been able to make an impact. I mean, the organized guys haven't been able to make an impact in terms of pricing, and so forth. So what's happened to Kajaria? It's down 50%. Yeah. So it's gone from 44 times earnings to 22 times earnings, FY20 PE. But having said that, at 22 times, is it necessarily a buy? I don't think so yet.
How are you looking at the overall valuation picture versus the core fundamentals when it comes to consumption? I believe that's a space you like. You like select FMCG stocks.
Right.
So what's the take on how one should battle that valuation issue?
I think given what I've just said about the market and where I see the market over the next 6 months, besides IT, the other place that I would stay invested would be the FMCG space. So valuations will gravitate, a lot of money will gravitate towards these sectors, I believe. And as a result, valuations in the FMCG space I don't think are necessarily going to contract.
What is it that you like within this space? Is it a rural-based theme? Are you looking at some of the select mid-caps? How are you positioning yourself?
Well, I think mostly the stocks in the FMCG space are large caps. There are very few mid-cap plays out there. So I think I'd stick to the large caps like the Levers or the Imamis and so forth.
And when it comes to private banks, what's your assessment of the kind of earnings that we've seen? Do you believe that a lot of the worries are behind and this will continue to remain a standout vis-a-vis the NBFCs, which you don't like, at PSU banks as well?
Yeah. So outside of the PSUs and the NBFCs, I think within the private space, I would still stick to the usual suspects. And I'm, kind of boring answer, but the fact is I'd stick to the Indus, Kotak, and HDFC Bank. Whereas Axis and ICICI are concerned, I think merely changing the CEOs doesn't solve the NPL problem. And I need to see more evidence of that before I actually get comfortable with them.
Okay. You're looking at gold finance companies in this market?
Yeah, so that's the other thing. I think within the NBFC space, the space that I think within that, the niche that we like is the gold finance space.
So simply because Manappuram.
Yeah, Manappuram is definitely the stock that we're looking at because the ALM there is very limited, and it's backed by, of course, gold, so significant. That's still about 70% of their business, and that's the reason we like Manappuram.
So if you're 100 rupees and 100 rupees is too small. If you had...
Let's make it 100 crore rupees.
I hope so. You're 100 crore rupees.
I don't have 100 crores, but someday I will.
All hypothetical.
He could be managing
your advice on having someday.
No, like they say on Wall Street that every man has a number.
Yeah.
So what is the number you're chasing?
No, the number I'm chasing is got a lot more zeros, but let's not talk about that. It's a different conversation.
Okay. How much would you allocate in equities? How much would you allocate in fixed income? And do you think, the sense which we got from Ray Dalio and Howard Marks when we interacted with these, legendary investors was that diversify, diversify, diversify. Right. So next 12 to 24 months, would you diversify immensely?
Yeah, I think the next 6 months will give, I suspect, enough opportunities to invest in equities, stock specific again versus the broader market. And of course, we don't know what the outcome of May 2014 is going to be in terms of elections, but I think that will give opportunities over the next 6 months to put money into equities. Having said that, I think putting money into fixed income products right now is not a bad idea to park your money temporarily and wait for that moment when equities start to rebound. Secondly, I think now may not be such a bad idea to actually deploy some money in the real estate space, given where prices are, given the fact that when you walk up to a developer with a checkbook, he's able to give you a further discount on what anyway is being quoted. So I would certainly look at that.
Okay. Well, I appreciate your time. Good luck with the number you're chasing.
Thank you. Like I said, a couple of more zeros.
Well, all the best.
Thank you.